this is Sage for Kalkine. A warm welcome to you to our next educational topic. For today, we are covering value investing. So value investing is an investment strategy seeking to target business that is selling at a level below their perceived intrinsic value. The investment philosophy was developed by Benjamin Graham and David Dodd, and it was elaborated in the book Security Analysis. Value-driven opportunities are found by evaluating companies according to book value or tangible book value. It is understood that value stocks are those trading at a discount to their book value or tangible book value or intrinsic value. So what are value stocks? Value stocks are traded at prices well below their perceived intrinsic value, typically due to some sort of headwinds that the business or the sector is undergoing. The intention is to buy stocks that are underestimated by the market at given price levels. It is also understood that market prices of stocks should reflect intrinsic value over time. So value investing is a long-term strategy seeking to buy such stocks, but not all quantitatively cheap stocks reflect value. Therefore, the focus on quality of businesses increased as quantitatively cheap stocks could sometimes reflect true value, rather relatively lower multiples than peers. Modern considerations in value investing. Competitive advantages. Competitive advantages are strategies for operating a business that gives an edge over the firms. Companies can develop competitive advantages by investing in intellectual property, know-how, improving labour productivity, geographical presence, and manufacturing at relatively lower costs. Also, developing brand image and awareness. Cash flows and applications. Investors prefer cash-generating companies, and companies tend to strive for high cash generation to achieve better profits and scale. Cash flows are crucial to pay off obligations and investments. Asset backing. The investments undertaken by a firm mostly result in the addition of the assets or increase in the value of assets. Value investors prefer companies having assets that could generate long-term gains for the business. Barriers to entry. These are the obstacles faced by new competition while entering a new market where existing players have developed a barrier to entry to avoid competition. Balance sheet. It is a financial statement of a company which enumerates the assets and liabilities of the business as of business date. Barriers to entry can include technological challenges, intellectual property, high startup costs, licensing, government regulations, etc. Thanks for joining us today. This is Sage reporting for Kalkine.